All right, let's look at a statement of cash flows. Now, first of all, I'm going to kind of go back to the last problem just for a second. I came back to this last problem because I want to look at the balance sheet. On the balance sheet, it tells you how much cash you have. So if we know how much cash we have, why do we do a statement of cash flows? I mean, we don't do a statement of supplies flows or a statement of prepaid insurance flow or any other asset for that matter. So why do we have to if we already know how much cash there is and it's easy to value cash, why is it so important to do a statement of cash flows? And I usually discuss this in the lecture, but the reason is because cash is a little bit different. First of all, a business needs cash more than anything else to stay going, because in order for it to pay its bills, it needs to have a supply of cash. However it got the cash, whether from operations or from loans or credit lines, it needs to be able to have access to cash to pay the bills, to pay the employees. If it runs out of cash and tries to get employees to wait for a couple of weeks to get paid, you can imagine how that works out. Another reason that cash flows is important is because cash is what would be the first thing people would try to steal from a business. Even if you have other assets like equipment that's stolen, what people normally are trying to do is steal something to turn it into cash, aren't they? So that's the reason. Also, cash is easily manipulated. We see this business has $6,850 in cash at this date, 12/31/17, but we don't know if it got the cash by taking a loan out right at the beginning, right at the end of 2017, just to pump its cash up, or maybe it sold some of its assets to make the cash look better because they wanted it to, so that it would look more solid. Well, since cash is easily manipulated and it's so important, we need this statement of cash flows to kind of give the investors and creditors a better understanding of the organization, of the risks that are involved in its ability to generate the money for sustainability reasons. So that being said, to do the statement of cash flows, what you need is some of your assets. You need to know assets and liabilities. So what you need to know is the difference between them, right? So we're going to do 2017, but we need to know where 2016 ended up and where 2017 ended up. And what you can do is, like, if you look back at 514, you see how they did increase or decrease. That's what I would do right here. Is create, write that in, or however you want to do it, because that's really what you're going to use. So the way the cash flows works is you're going to have operating activities, you're going to have cash from investing, and you're going to have cash from financing. So financing, let's go the opposite way. Financing is getting the money you need to buy the things you need, that's investing, to run your business, that's operating. So if you wanted to start a restaurant, you're going to need some stuff. You're going to need a building, tables, chairs. You're going to need ovens and cooktops and all that stuff. So getting the money to do this is financing. So you would get the money through loans or through investments. That's really the only two ways you can get the money. I mean, even if you saved up your own money, that would be your own personal investment. So that's really the only two ways. So that's what's going to be the financing activities. Investing activities are buying the things you need, right? So buying the equipment, buying the tables, buying the building if you bought it. And then operating activities is taking those things that you bought and investing and running the business and seeing what kind of cash you get that spins out of those operations. Okay? So typically financing activities are typically positive because it's usually you're getting money in, but it doesn't have to be, but typically it is. Investing activities are typically negative because you're usually buying things that you need for your business. And then operating activities, you hope for those to be positive. And then over the long term, you'll notice that operating activities hopefully are positive. And then if you don't have any equipment to buy, then you might invest in stocks in another company. And then financing activities, if you don't have any need for financing activities, sometimes those are negative, like in this case where they pay a dividend. All right, so that's kind of an overview. So let's start with operating activities. Two ways you can do it. You can use the direct method. In the direct method, you say, all right, we're going to count every dollar that comes in from operations, from a sale, and we're going to count every dollar that goes out from writing a check. And the only problem with that is that most bigger businesses, they base their system is based on the accrual basis of accounting, not the cash basis. And because of that, they don't have that information readily available. So what they do instead is they use the indirect method. So the indirect method says, let's take the accrual-based net income and back out things that aren't cash. So if something's not cash, then we back it out, or we adjust for the effect. So sometimes the effect will be good, sometimes the effect will be bad on the cash. And then we'll get the cash from operating activities that way. So that's why they call it the indirect method, because you take the accrual basis and then you back out the effects of accrual accounting, and you end up with what would it be if you were using cash accounting. So let's start with the net income. Net income is 160. Okay, great. So now what we want to do is take the differences from each of these. So depreciation. So you see the depreciation went from 89,000 in 2016, and then we had some more accumulated depreciation of 106. So that means that depreciation went up by 17,000. So depreciation is not a cash situation. So that means that you're going to back it out. You didn't write a check for depreciation, so you're going to back it out. And what I mean by back it out is you're going to add it back to income because you didn't write a check for it. So I provided this in your PowerPoint slides. This is a handy dandy little slide here. And so you start doing the indirect method. You start with net income, and then anything over on this side you add, anything on this side you subtract. So you can find this in the PowerPoint slides that I personally provided in the announcements. I think it's the week 1 announcements. All right, so we have add depreciation, and if we had amortization, we would add that. Okay. So if we were looking at this for the loss side, we would want to adjust just for the gain or just for the loss. So we had some, let's say we had some equipment, and we sold it for $1,000, whatever. It doesn't matter how much we sold it for. Here we just want to adjust for the gain or the loss on it. So the book value versus how much we got is going to be the gain or the loss. Just for the gain or loss. So it says that their investment was sold at a loss of $10,000. Okay. Here it says a loss on the sale of assets needs to be added back. If we had a gain, we would subtract it. So since it's a loss and our slide says to add it back, we add the loss. Okay, just the loss, not how much we got from it. Okay, so we're obviously not going to have enough time in this first one to do the entire problem. So I'm going to come back and do part 2.